Good afternoon, everyone. Good to have you here. I'm very excited to be here hosting this panel, Main Street Adoption of Tokenized Assets. I'm Michelle McCory, and as a global financial journalist, I have spent well over the past 2 decades covering markets, monetary policy, and some of the biggest shifts in the global financial system. I covered the 2008 financial crisis, the era afterwards with unprecedented central bank intervention, the rise of ETFs, index funds, passive investing, of course, the emergence of Bitcoin and the rise of digital assets, crypto going from a retail market to institutional adoption, how the retail investor has recently expanded in terms of access via platforms like Coinbase and Robinhood, from crypto to meme stocks, creating millions of new participants in the financial markets, fundamentally changing how people access and engage with financial assets. So access has clearly expanded, and now tokenization of real-world assets is being positioned as the next phase, not just broadening access to asset classes, but also bringing in new asset classes to the space. And we know this is something to be taken seriously because leaders like Larry Fink of BlackRock have called this the next generation of markets. BlackRock has already launched some tokenized funds. JP Morgan is working on the operational and tokenization stage. So the biggest players are already there, the change is here. And as with every change, there's always some trepidation and some healthy skepticism. We saw that when we went from paper to digital, from floor markets to electronic markets. There's always concerns about transparency, control, risk, sovereignty, and the same is happening in this era. And that is what we aim to address on this panel, some of those concerns, particularly for investors, as well as some of the tremendous opportunities and potential and promise that RWA tokenization brings to investors, and efficiency, fractionalization, democratization of asset ownership just being part of those. And for that, we have on stage real companies that are using platforms to raise capital. We have the infrastructure, the platform, and the real companies all represented on this panel. So let's introduce them. We have Uber Javid, founder and CEO of Nomics, building the identity and compliance structure that underpins tokenized markets. We have Tyler Ehler, founder and CEO of Tranquil Healthcare, an FDA-approved treatment provider using tokenization to raise capital and expand access to care. And Omar Karim, Chief Revenue Officer at Adapty, bringing the creator economy and the college and general athlete ecosystem into investable markets. And as we discussed, you are already listed. So before we dive into the panel, just want to gauge the temperature of this audience. By a show of hands, how many of you already own any tokenized RWA? All right, we have one. Okay. And two? Two. We have two. And how many of you are generally comfortable with the idea of investing in tokenized RWAs, real-world assets? What is that?
Better show of hands, like 6?
Okay, 6. All right, well, we'll check back in afterwards if we've allayed some concerns and answered those questions. But I think let's kick it off. And for the first round, how about just a brief introduction, what you do, why you're here, how you fit into this ecosystem. We'll start with you, Abir. Nomics, the identity and compliance infrastructure.
Well, the identity and compliance infrastructure is really the beating heart of our system. It underpins some of the technology that we've delivered to our partners, such as T7X that was just on the stage earlier. But really, we're a tokenization infrastructure play that allows traditional asset managers to transition on-chain and adopt tokenized assets without any of the friction points that are typically associated with the adoption of blockchain technology. We've completely hidden away the wires on blockchain tech, where to the end user, it feels like an evolution of the platform that they're already accustomed to using. We handle everything from investor onboarding, compliance management, not just compliance management at the time of onboarding, but also throughout the life cycle of the fund or the financial instrument that's been tokenized. And then obviously the subscription, the redemptions, the distributions, and we link into some of our other ATS partners such as T0, Onera, and T7X that allow us to distribute these tokenized assets, because it's great to tokenize assets, but then what? Who's actually going to buy it? Distribution should always be manufactured, not assumed. And we allow traditional asset managers to have a turnkey framework to adopt this new paradigm of financial institutions.
All right, we will get into some of those issues, but for an investor sitting in the audience, what has fundamentally changed in their experience and access to this market because of what you have built? What problem are you actually solving for?
So typically, if you're investing in RWA assets, there's a certain level of crypto fluency required. That crypto fluency can mean you need to manage your private keys. It means you need to actually fund your wallet with gas fees before you can actually transact. The concept of having US dollars and not having enough gas to actually buy an asset is very foreign to non-crypto native investors. What we do is we abstract away all of that complexity. So to the end user, we provide a very brokerage-esque experience where not everyone can use a MetaMask wallet or a Ledger wallet, but unless you've been hiding under a rock for the last decade, everyone can use Apple wallets, right? So we create a system that requires barely any training for the average Joe to actually start using and leveraging tokenized assets. So that's the first part of it on the end user and the investor side. On the asset issuer or the asset manager side, the challenge with tokenization was any incumbent tokenization engine provides you with one piece of the puzzle, which is, here's the tokenization part. Now, good luck with your KYC. Good luck with your transfer agent. Good luck with getting a banking rails infrastructure. Good luck with getting your Edgar filing and reporting done on time. The problem with that becomes tokenization, instead of being a streamlined and optimized solution, it now becomes an IT project, where even before the asset manager has issued anything, they've signed 5 contracts with each minimums of their own. They've committed to $500K to $1 million in infrastructure costs, and then they have to hire a team in-house to actually integrate all of those solutions together. What we are able to offer asset managers is something that will allow them to go from 0 to issuing their assets in their white-labeled tokenization infrastructure in as little as an hour.
Little as an hour, okay.
In little as an hour.
So really, really streamlining the process, then making it more user-friendly. Something that Tyler will be taking advantage of, or is already taking advantage of. So tell us about Tranquil, what it is, what the company is, and why you're using tokenization as the way to capital raise.
Definitely. Thanks, Michelle. Can you guys hear me okay? So Tranquil is a specialty financing company focused on mental health clinics, specifically TMS clinics. TMS stands for transcranial magnetic stimulation. So what we're doing is we're using the Reg A to raise up to $50 million to finance these clinics, and we're doing this through the tokenization process. So I actually come from a biopharma, biotech background. I've been part of a $75 million raise, $100 million raise, and I've been part of a public company that was $6 billion at peak and went down to $100 million. So part of the reason that tokenization excites me so much is it democratizes access to this opportunity. When I was part of a private company trying to raise $75, $100 million, no one could come in with a $5, $10, $25, $50, even $100,000 investment because it would ruin the cap table, and the founder and the board didn't want that. And this really allows access to everyone to come into this opportunity and be a part of it. And then on the other side of it, I saw a company go from 6 billion to 100 million, and then we brought it back up to $500 million after a ton of work, but you don't know what's happening on the other side. The amount of time and effort I'd spent trying to find who was buying and selling our stock on the other side was extremely difficult. And I love the tokenization aspect of this because there's actually transparency in who is buying and selling, and we can actually see who's going. You don't have the ability to short it. And it just creates a lot more control that we have over this process. And I know you'll probably have some questions about that later, but that's high level what we're doing.
All right, that's high level. We'll get back to, we do have some questions there. Omar, Adapty, already listed. Tell us about that, and tell us why an already listed company is also offering tokenized access. And tell us a bit about the company, of course, as well.
Yeah, thanks, Michelle. So I'm Omar Karim. I'm the Chief Revenue Officer at Adapty. We're a publicly traded sports media company. And just a quick story that ties me into how I ended up here today. 15 years ago, I was a co-founder of a fintech company that did bill splitting and peer-to-peer payments. It was us, WePay, and Venmo making our rounds with VCs in Silicon Valley. Everybody knows Venmo. Nobody knows PayDivvy. We did sell to a publicly traded bank, but during that capital raise, I sat on a panel like this at a fintech conference and was the antagonist for the viability of cryptocurrency. Essentially, my argument was that no sovereign nation would allow a tertiary currency to influence its capital markets, and it's fundamentally against national sovereignty, right? After that panel, a well-known celebrity investor came up to me and said, "Hey, you did a great job. I agree with everything you said. I'm still buying 1,000 Bitcoin." They were 33 cents that day. And I had just had a new baby and didn't want to put $330 into it. And so I'm still working and I'm here today. But now I'm an advocate for the blockchain. And we are a publicly traded company, so you can buy our stock. But we're doing a Reg A debt round with T7X, and it's more of a philosophical connection than a technical one. Adapty is really differentiating itself in the professional sports agency industry by focusing on accelerating an athlete's revenue potential through brand sponsorships in a more direct consumer and fan engaged way than traditional sports agencies. And it's a retail play. And we really like how the blockchain at T7X allows investors, retail investors, to connect to an asset and engage in a debt round of financing at a smaller level than your institutional investors would typically play at.
So seeing as we're on you, we'll work our way backwards. As an investor, why would I buy a tokenized version as opposed to a straight equity play? What's the difference? What's the upside?
So stock is stock, right? You can buy it and sell it on an open exchange. The Reg A investment is a structured debt investment with a 3-year term. It has a guaranteed annual return. And it's a different capital play for us as a company. We can take that debt and acquire companies. We have a buy, not build growth strategy. So we need both. We need our stock to move, but we also need capital to grow. I think the advantage to the investor is that it's in the crypto arena. So they can potentially get their distributions back in a crypto coin. And that's kind of the whole thesis of T7X, is that it's not just simple supply and demand driving the price of the coins on the platform. It's the real world asset and the performance of those companies that lend credibility to the currency.
So beyond the crypto wrapper and the ability to transact in crypto tokens via the platform, what is the difference? And in terms of, also elaborate on what the investor is getting, what is the revenue stream, what is the underlying value proposition?
Yeah, so it's preferred stock, a 10% annual return, 3-year term, whereas buying the stock, you're subject to the fluctuations of the stock on the open market.
Go ahead, you want to jump in there?
I can add to that just a little bit. So yes, there's a benefit of instant transactions. There's a benefit of instantly being able to get your distribution yield in USDC with disintermediatized parties, so you're not paying as many transaction fees in between. But really, what the true promise of tokenized assets is, and it's still emergent, they're still very early and young platforms that are showing up, such as Aave Horizon, and I know there's something on our partner roadmap here as well, is the ability to cross-collateralize performant asset classes, probably over-collateralized to start until they get a decent enough rating, but being able to extract liquidity from a traditionally illiquid asset without having to call your GP up or without having to call your fund admin up and have them place this asset class. So what would happen in a traditional asset, which is illiquid, similar to a 3-year debt note in Omar's case? let's say someone's getting divorced, someone had a baby, someone had a life event. They need to exit an investment that they potentially still believe in. They need an injection of capital. There would be an illiquidity discount. You're probably going to get 20% below NAV, if you're lucky. Then Uncle Sam's going to come in, he's going to take his 10 to 20% away. Then the broker dealer is going to collect another 5% for the privilege of being able to place it. By the time it's all said and done, you're at about 40% of your NAV. And with tokenized assets, being able to collateralize this asset and get liquidity out against it still allows you to participate in the future upside of that asset while having the yield that's been paid to it, paid against that asset class, pay off your monthly payments. So you got that immediate liquidity.
And that sounds fantastic, creating liquidity out of collateral that otherwise would be difficult to. But I'll throw it to Tyler. How real is liquidity in the secondary market, though? Isn't liquidity a real issue, at least at this stage of the game?
So having come from a private sector where you invest in a private company, liquidity is a real issue. Because often you don't have the ability to sell unless there's some sort of raise or you're waiting for an IPO. Sometimes you invest in a private company, you're waiting 10, 15, 20 years, and maybe, honestly, you never see the money sometimes. So what really excites me about this opportunity is, A, for what we're doing, either you have to go to a mom and pop psychiatrist shop who's setting up a TMS machine, and they probably don't want your money because it's more hassle than it's worth. Or private equity is investing in this, and they're not going to let you be part of the game because they want control of that asset. So what this creates is from the bottom up opportunity where we can raise up to $50 million, and similar to Omar's doing, we have the 8% yield and 70% distribution. And it creates this opportunity on the alternative trading system where you can come in, you can buy, and like Hubert was saying, if you have a major life event, if you have a baby, you're buying a house or something, there's going to be buyers on the other side. So we're right at the very beginning. This is very nascent. But in the coming months, there will be an opportunity to sort of buy and sell, and that's really why we want to be part of this and why I'm so excited to be part of it. Because I also don't want, as a founder, as a CEO, as an operator, you also don't want someone who owns $5,000, $10,000 in your company calling you every month, because then it's just focus away from the bottom line and what you're trying to do to build the business. So that's a big part of it, is we want that opportunity to be there for liquidity and people to be able to sell if they need to.
For there to be real liquidity, Hubert, does there need to be cross-platform availability? Is that coming?
So there's two there's two schools of thought here. One is, yes, creating cross-platform collateralization capabilities where you're able to take coins on Base and collateralize them in ETH, or take coins on Solana and get liquidity out from the Aave Horizon platform on a different chain. That's one part. Then the other part is your traditional liquidity providers. Who are your traditional liquidity providers, especially in the private asset segment? It's your private equity shops, or it's your banking institutional players. Right? These are the ones that are actually underwriting any loans that you're providing against these otherwise illiquid asset classes. And the caveat to that is they have to be performant. You're not just buying, these banks are not going to underwrite an asset class where you're just hoping in 7 years it's going to sell for 5x or 10x what it is. But if it has historical revenues that are being distributed like clockwork on a biannual, weekly, quarterly basis, in that scenario, the underwriters at the bank feel comfortable enough to provide liquidity in forms of a 20, 30, 40% LTV loan against these asset classes. So it's making these traditional institutions, and even in certain cases, neobanks, whether it's the lending protocols or it's your neobanks, feel comfortable with underwriting these asset classes. That's the challenge, to create liquidity. And liquidity should never be assumed, it should always be manufactured. And it really depends on what pathway you want to take to get to that liquidity.
All right, so liquidity is still something that's an issue, but as expected, as a nascent class, that is something that will grow and develop. What about awareness, Omar? How do you create awareness of this investment opportunity for investors? What's the pitch? Like, why would somebody go for this type of investment asset?
So, for our company specifically, we're in the business of sports. And sports is driven by fan engagement, and fans are willing to invest in their passion, their loyalty to a club or a player, but there's no vehicle to do so. So having a retail investment option is unique, in the space, and it allows us to drive awareness and engagement and investment at the fan level, which is cool.
So we hear fan level, we hear engagement, we hear influencer, and a lot of people kind of cringe and say this sounds a little bit like NFT to me. And we know that didn't really come out as promised. So what's the distinction? Why is this, and in this particular sector, different?
Well, NFT, at its origin was subjective value of art, right? And
is this not a subjective value of an athlete's potential or channeling fandom?
We're a real business that's been in business 10 years. We have $10 million in revenue annually. We're growing year over year. So it's not a subjective investment. You're investing in a real world asset, quite literally, right? But in a company, I think fundamentally it's just totally different. It's even different than just investing in any other cryptocurrency, which is almost solely driven by supply and demand. This is driven by the fundamentals of an operating company with real revenue.
So what problem does tokenization solve in your business that you wouldn't be able to solve it otherwise? From the business perspective.
Yeah, I think it's reach, availability, and transparency primarily. To invest in a private company, you'd have to be a sophisticated investor or an institutional investor historically. And this allows a level of transparency and government regulation that is, can make your average retail investor comfortable putting their money there.
And it's not to say that you can't have that transparency in traditional sense. You can't have that investor reach in the traditional sense. But the cost and the economics of doing it without tokenization are at times preventing companies like Adapty to actually go through a Reg A offering. They would probably just do a Reg D in that scenario. Or if they were to be transparent and auditable to regulators, part of the reason why they only take $10,000, $500,000 ticket sizes instead of $100,000, $50 ticket sizes is because the labor-intensive process, if it was done in the traditional sense, would be cost prohibitive, or it would take away a significant chunk of his bottom line.
And we'll get into regulation in a minute and explore that and how the Reg A structure may create some solutions and some transparency for investors. But I want to kind of zoom out and talk a little bit more of some of the macro, big picture concerns. And one of them, Tyler, and I know you and I chatted about this briefly, is the idea that this, in fact, is a negative under the framework, or seeing it through the prism of what we heard from the World Economic Forum, you shall own nothing and be happy. That this in a way disenfranchises people, that you're over-fractionalizing ownership, and at the end, nobody actually owns anything. You don't even own your home because now you've sold portions of your home to big institutions, and you're losing sovereignty over assets. Ownership and sovereignty and liberty are all intertwined, and this may seem amazing right now, but big picture, you're part of the digital grid, you're part of the digital control system, and subject to control, surveillance, programmability, and all of the sort of dystopian and negative scenarios that some people associate with over tokenizing and putting too much stuff on the digital grid. How would you address that concern?
So before I answer that, I'm just curious from the crowd, show of hands, who has invested in a project with a bad actor that they've lost money in? Okay, maybe about half the room. So I think, Michelle, to answer your question, I think it's easy to conflate surveillance with compliance. And I think what the Regulation A offering does, and tokenizing this asset does, is the Regulation A offering actually provides a level of security and compliance to an investor. It allows transparency. It allows strict enforcement to SEC compliance. So what we do in particular is we do TMS clinics. So it's an FDA-approved treatment. It's been through a rigorous testing process, thousands of patients. If I want to go to a doctor and I want to have surgery, I'm not going to go on vibes and that I trust this guy to do my knee and he's, trust me, bro. I think I want that level of compliance and that level of protection. And I really think that doing this Regulation A and doing the tokenization offers that. And I think it's easy to make this boogeyman of surveillance and we're watching. Yes, we are, but at the same time, there's a level of protection behind it that protects the average person, the average investor. And I think at the end of the day, it's easy to say we don't want that level of compliance because we're being watched, sort of thing. And I think it's easy to mix that up. But at the end of the day, if you lose money, you want to be able to get it back or be protected or know what's happening. And you want to be able to know what your investment's doing and be able to watch it. You want to be able to get biannual reports, annual reports. You want to see the revenue figures, expenses, where the money is actually being spent. And I think a lot of times what happens is you have, this isn't an ICO where you have no idea what's happening, you invest in it and it's a moonshot and you hope, but really the founder often just takes the money and runs. That's not what's happening here and that's not what we're doing, and I think that's partly why I'm so excited about it.
Yeah, I think at the end of the day, people buy from people, right? You don't buy a water bottle because it's the only water bottle available. You buy it because you trust the brand, the product. And when you get into markets where you don't necessarily have a one-to-one relationship with the person behind it, you need that technology and the assurances of regulation to have the confidence to do business with them. Because putting your money somewhere other than your own pocket is solely predicated on your confidence and trust in where you're putting your money.
So I want to actually jump off that, putting money in your own pocket. Show of hands here. If you're a crypto native, how many people have a significant chunk of their holdings on a centralized exchange rather than a ledger? Okay, couple here. What about how many of you people have the significant amount of your fiat net worth stuffed under a mattress as opposed to a bank? No one? Huh.
Do gold coins count?
Yeah, to a certain extent, right? Now, the fact that we are trusting in institutional players such as Chase or Wells Fargo or pick your banking institution to actually custody your assets, isn't that the same thread of surveillance and compliance?
But the argument is made that yes, this gives access to asset classes, but perhaps creates asset classes that should not have fractionalized ownership in the first place. Like if I own a house and I now start to sell fractionalized ownership of that, then I'm even subject to big brother control, bigger on the grid. On the flip side of that.
I'm personally opposed to participation right tokenization and fractionalization of tokenization. If you can't afford a full unit, probably not the best thing to invest in. I'm more so for one-to-one asset-backed tokenization where one stock certificate is being tokenized one. It's not a derivative product. It still contains your governance rights, your participation rights, your voting mechanisms that transition alongside that token. Fractionalization is a whole different story altogether.
And yet that's being pitched as one of the great virtues of RWA tokenization, that it democratizes access to people. People that, for example, you're dealing with depression treatments. There could be people that have a personal connection. They want to invest in a space not only for financial gain, but because it's something that hits close to home. And here's an opportunity for them to do so. Do you see that sort of ability to open up investment classes to a variety of investors for a variety of reasons as one of the big benefits of tokenization?
Absolutely. So TMS treats depression, as you mentioned. It also treats autism. That's one of the treatments. It's EU approved. It's not FDA approved. Every time I speak at a conference, someone comes up to me and says they have a child or they have a friend of a child who suffers from autism. And I think especially what Tranquil is trying to do is really help people and help people who have children suffering from some form of mental illness at the end of the day. To build up one of these clinics costs $1 million. So to your point, this isn't, it's not $1 million home, it's $1 million clinic that's treating upwards of 40 patients per month through the course of the year. So you have hundreds of patients being treated through the course of the year. So for a lot of people, especially for what we do at Tranquil, it's a personal decision to invest in something that's hopefully helping someone at the end of the day down the line. So it's meaningful to people, and some people want to invest to make money, and we want everyone to make money who invests in us as well, obviously. But some people invest because there's meaning to it or purpose behind it. And I think that's partly what Tranquil is trying to do as well.
And it's meaningful, much like investing in Adapty is meaningful if you have a connection with a particular athlete who taps into passions and taps into interests and allows a crossover there between investment and interests and passion. But let's now move on to what you all think is the biggest risk to the investor via this type of platform. And I'll start with you, Omar. In general, not necessarily as specific to Adapty.
Well, I don't think the risk is inherent in the platform itself. I think the platform minimizes...
More tokenized assets per se. Like, what would be the biggest investor risk when you invest in RWA token, regardless of the specific platform?
Yeah, so the investment is in the company. The tokenized asset is the currency in which the investment or distribution is made. So it's much different than investing in a standalone currency, right? The risk is the same as investing in a company with cash. I don't think I draw a line between the two. It's just the vehicle of receiving and distributing the funds. That's different. It's more transparent, and it has less, much less risk of market manipulation. So I don't really see a downside to it.
No downside at all. Okay. Well, Tyler.
And back to your last question, Michelle. It's a kind of a pessimistic question, but we could flip it back to you. Would you rather have your neighborhood TMS clinic treating your neighbors of depression owned by Eli Lilly or Pfizer, or by 1,000 of your neighbors, right?
Depends on my neighbors in the neighborhood.
Well, hopefully your neighbors are better than
Pfizer?
than drug pushers.
So I think to your point, every investment has risk. I think what we do, we're financing TMS clinics, we're investing in them, so we're providing loans to operators. So obviously there's always a risk that an operator defaults, something doesn't happen. But the revenue stream we have is strong in terms of the FDA approval, the FDA reimbursement. So it's the same as any business, but I think the difference in what we're doing is that we have SEC compliance. You can actually see what's happening. There is going to be that alternative trading system where people can buy and sell. There is obviously risk that the buildup is slower, it's nascent, and there's less liquidity to start than you might want as an investor. But I think that all the protection, all the guardrails are in place that de-risk this as much as possible. But to your point, anything can go back. Look at Intel, it went down and now it's coming back up 15, 20 years later. So I think any investment carries risk with it.
Hubert?
Liquidity. Right. Back when tokenization first started off, people tried to circumnavigate legal through tokenization. Every single person and their dog was coming up with a way to say they were a utility token and not a security. Thankfully, we've all passed that in 2023, especially with the headwinds from regulators turning into tailwinds that facilitated that shift that, no, we do need to comply with the frameworks that are existing governing the underlying asset class. Now what I see people doing is they're trying to get away from marketing and placements through tokenization, which is if we tokenize it, we'll get all these people that are going to buy it. No, you still have to go do a certain level of market making. You still need to do placements and build critical mass before it'll actually organically grow and turn into a perpetual machine. So that's on the business side. Now, as with any piece of technology, there is always a risk of smart contract or technological issues. But due to the guidances that we've received in issuer-sponsored tokenization from the SEC, you can have the master security file on-chain, or you can have the master security file off-chain, with the on-chain being a transactionary layer like Omar was stating. The way that we've built our entire infrastructure is even if someone from the Lazarus group in North Korea was able to compromise one of our investor wallets and they tried to send assets that were issued by Adapty or Tranquil off to a wallet that isn't registered, that hasn't gone through KYC, the transaction would simply fail. And if someone tries to probe our infrastructure to potentially even start compromising our core infrastructure, we work with partners that power some of the largest asset managers in the world, including Apollo's foray into the digital asset space. That would basically freeze the contracts until we find what they were trying to do, what vulnerabilities they were trying to exploit, patch them, and then restart the trading.
So obviously this comes back to regulation and oversight in a big way, because a lot of crypto investors have been burnt. A lot of people have seen FTX exchanges that have just poof, disappeared. Celsius, believe me, victim of one of them myself.
Same.
You know, with
Same.
great returns, invest in something, expecting yield, then the whole thing just disappears and collapses, and you're somewhere on the creditors list, never to actually get any kind of return.
So do you know the only country where FTX was able to return investor capital or had the capability to return investor capital? I didn't actually research properly.
I'm guessing it's not the United States.
Obviously not. It was Japan.
Ah,
Why? Because they had previously had hacks, especially associated with the Mt. Gox hack from way back in the day, where they clearly dictated the segregation of investor capital and fees generated from that investor's capital, and then exchange operational slush fund. Those were three completely segregated tranches with a third-party arm's-length custodian where Sam Bankman-Fried couldn't just come in and sign a transaction and say, yep, I'm going to repurpose this for Alameda funds. So it all comes back to oversight and governance and properly enforcing that oversight and governance. Some of it is done at a voluntary level, such as with Reg A's today,
Right.
but a lot of it has to do with the right regulators saying, I'm going to conduct audits on you on a weekly, monthly, biannual basis to make sure you're in line.
so, you know, where are we with that? Because obviously T7X does provide a Reg A plus structure, so that allows some oversight, some compliance, but that's a voluntary approach. And as we know with all new technologies, there's usually a very serious lag between the technology and government and regulation stepping in. And with that comes pros and cons. Omar, what do you think we need to see for there to be more, less concern from an investor perspective that this isn't, I'm buying a token on some exchange that could just disappear overnight? What kind of regulatory change, what kind of government intervention do we need to see to allay those concerns? And where are we in that process? And I'll throw it to you, but it applies to the whole panel.
So we're a public entity. We're going through our 10K filing now. And I think, you know, something on par with traditional capital markets in terms of regulation is where we're headed and what's needed, right? It's currency has traditionally been regulated by big actors posing as government. Right, I got a smirk out of Uber on that one. But I think, you know, in terms of blockchain and crypto, wider adoption will prompt faster regulatory response from the government, and wider adoption will be driven by things like real world assets entering the market.
Yeah, and I mean, for us, for Tranquil right now, we're a private company, so we could technically we have taken some investment from accredited investors, but we will not be live and will not be tokenizing until the Reg A is actually approved, until there's that SEC compliance in place, and the SEC can actually see it and approves us going on this tokenized platform. So there's that level of protection and regulation that is going to be behind the investment before people can actually go out and buy it. This isn't something where we're tokenized right now without the SEC approval. We're not doing that. We're waiting for that approval, and once that's done, people can buy and sell. So there is going to be that protection in place and protection that exists, and the SEC is going to be monitoring and watching everything, and we will have strict regulatory compliance that we need to follow through and provide the SEC and any investor with. So we're not tokenizing until that happens, and the big part of it is to protect the average person and protect the average investor. And we're giving yield, we're giving 8% plus a profit share, but we're doing that under the guise of the SEC and not, you mentioned Celsius, going to Celsius and trying to chase yield and putting more and more in because the yield's great, but then there's nothing behind it. Everyone's gonna be able to see our cash position, what we're doing, and where we are, and where that cash is coming from. So there is gonna be that level of protection before we tokenize.
So I would just like to correct one thing. Going down the path of the Reg A is voluntary, but what you have to provide as part of audits and financial overviews is not voluntary, right? These guys could have gone down the pathway of Reg CF. Sure, they would raise slightly less capital, but it's kind of a cowboy, wild, wild west. how many products have gone on Kickstarter that have raised million that never actually end up delivering anything at all? So going down the pathway of Reg A is voluntary, but the oversight you need to provide once you've embarked on that journey isn't voluntary.
Right, yes, well, once you've embarked on that. But in terms of the framework that's needed, do you see Reg A becoming the default, or do you see regulators coming in and creating a whole new framework, and this is just a good workaround for now?
I think Reg A's existed for a few decades. It's from before my time, right? So this asset class has existed. The rules governing have existed. We're just simply putting it on a new mode of transfer, right? And as it comes to CEO of a tokenization company, sometimes I think tokenization is a dirty word, right? Most of the clients aren't looking for tokenization.
Well, where are we in terms of the legislative process?
So
where is our government on this?
For the last 4 years, we saw a lot of innovators actually leave the country, right? Including myself. I was exploring Dubai, I was exploring Europe because they were actually hosting sandboxes. This current legislative environment has significantly improved the perception of blockchain innovators here in the United States. And on February 6th, if I'm not mistaken, or the first week of February this year, SEC released general guidance on tokenization, which was third-party sponsored tokenization and issuer-sponsored tokenization. What all three of us on the panel here today are doing are issuer-sponsored tokenization. Now, for those of you, the gentleman that had actually bought RWA tokens previously, I don't know where he went, but I'm guessing it was on a...
He's right there, one of them.
I'm guessing it was on a platform such as Republic, right? And what Republic is doing is great. They're pioneers and trailblazers in the space, but what they use is something called a mirror token, right? They're very clear about this as well, which is they acquire shares in a particular company, they then put that company in a wrapper, the company has no knowledge whether the asset is being tokenized or not, and what are the potential implications of it? What if the company decides that they want to claw back all of those shares? What are the rights of first refusal with that company of distributing that asset out? That's somewhat unknown. We're hoping that the independent party that you actually invested in that had nothing to do with the issuer actually dotted their I's and crossed their T's. With issuer-sponsored tokenization, things are different because you have a direct relationship with the actual entity that is in charge or is authorizing the issuance of the underlying asset. So I think the SEC guidance on February 6th was great. Wyoming and one other state, it's either Nevada or Colorado, can't remember which one, has already adopted some of those issuer-sponsored guidances in order to have a master security file start operating completely on-chain. So I think over the next 3 to 4 years, we'll see legislation always trails innovation. And over the next 3 or 4 years, I think we'll start to see this industry mature a bit more, especially led by the deep pockets who have the deep pockets to actually lobby government groups to come up with conducive regulation to tokenization. My only hope and expectation is that they don't stifle innovation by closing the door behind them. That's the other risk that I see with leaving this in the hand of the big.
All right, we're wrapping up and we're running out of time. Very quickly, what does the industry need to scale, and where do you think we'll be if we were on the stage in 3 years from now? Very quickly, 30 seconds each.
Sorry, what was the question?
What does the industry really need to scale, and where do you think the tokenization of RWAs will be if we meet again on the stage in 3 years' time?
I think Hubert touched on this right at the beginning, but it's making the concept of exchanging the currency and engaging with it simpler. That'll come with adoption. It'll come with, maybe unifying platforms. But the process is scary to people that aren't already familiar with it. And I think engaging with companies that have a wide follower base across multiple industries is a good way to pollinate it into those segments that aren't currently familiar with crypto.
I think awareness and opportunity. So awareness of the fact that you can actually tokenize an asset and you can buy and sell a tokenized asset and a private asset with yield that's actually protected by the SEC. And I think in 3 years, more and more people are going to be aware that this exists and aware it's an opportunity. And if you told me I could buy a stock I'm a biotech guy in an early stage biotech where a drug might fail, or something where I'm being told I can get a return and a profit participation, I'm going to go with the one that I can get a return and protect my cash. And I think that is only going to grow in the next few years. And 3 years from now, I think there's going to be a lot more RWAs and a lot more tokenized assets here.
A lot more. Okay.
So a couple of parts to that. Number one, you need a middleware layer which is able to reconcile the legacy infrastructure with blockchain infrastructure. They two need to be able to cross-pollinate each other. Otherwise, you end up with silos. Secondly, a composable, reusable digital identity which can enforce compliance rules at a token at a transaction level. So you're transforming compliance management from a pre-transaction check or a post-transaction audit to a part of the transaction itself. And then last but not least, the platform needs to look and feel like an extension of something both retail investors and institutions already use today, not something that they need to train on. I've been in blockchain since 2013, and even now when I send anything over $10,000, I'm actually reading every single wallet letter. And that's jarring to the non-retail investor. So if we can have a confluence of all of those three things, I think we will hit the $16 trillion mark in tokenization that JP...
In 3 years' time, $16
2030.
trillion. Okay. 2030, $16 trillion market cap for tokenization. We are out of time. Quick show of hands. How many of you feel a little bit more comfortable with investing in RWA tokens after this conversation? Did we make any progress? A little bit, I think.
Sounds
I
like
think
it.
so.